It's Thursday, the 12th of March, and this is your Capital Economics Weekly Briefing. I'm David Wilder. It's day 13 of war in the Middle East. Depending what you're watching, who you're reading, who you're listening to, this conflict is going to end soon, or there's no end in sight. Our job isn't to forecast how the fighting's going to play out or when it's going to be over. It is to explain how this is all influencing the global macro and market outlook. To that end, I've got with me Group Chief Economist Neil Shearing, David Oxley, who is our Chief Climate and Commodities Economist, and Deputy Chief Markets Economist Jonas Golterman. Hi, guys.
Hi, David.
Hi, David.
Before I do anything, I want to just timestamp this because things are moving quickly. So we're talking just after 9 o'clock London time. That's sort of 5 a.m.-ish in Washington, around 12:30 in Tehran. David, let me start with you. The oil chart, it looks more like a chart from one of those meme stocks that they trade, doesn't it? We've gone from around $80 a week ago to nearly 120, back down to 80, then up to 100 overnight. We're not far off that now as we're speaking. You did warn clients just yesterday that oil could be back at $100 before long. So talk about how the market is pricing risks now, because we're coming off the back of this news of this massive release of supply coordinated by the IEA yesterday, but now we've got tankers on fire in the Strait of Hormuz. So pull it all together, what is going on?
Yeah, well, I think things are incredibly volatile at the front end of the energy price curves. We've seen oil volatility spike to levels much higher than seen in 2022. You have to go back to COVID shock for oil volatility being as high as it is now. We've seen not only just in crude and gas markets, you're seeing huge swings in oil products markets as well, particularly jet fuel, which reflects the fact that the Middle East is a substantial refinery centre for the world, so that's been affected as well. And we're seeing really unprecedented blowouts in the physical market with the spread between Dubai and Brent. Dubai clearly trading at a huge discount to Brent. So yeah, I think we're seeing some unprecedented moves. The other thing is worth just flagging is just how sensitive developments in the energy markets appear to be just to the news cycle. Well, understandably, but what we're seeing is sizable moves coming on the back of tweets and deleted tweets. So I think it's pretty febrile at the front end of the curve, as you'd expect. At the same time, amid some of these breathless front end moves, I wouldn't describe it as calm, but there is a greater sense of calm in other corners of the oil market. We have a proprietary indicator that looks at how the options market is reacting. And if you look at the options market, clearly traders are more or are less certain of where prices are going to be in 3 months' time, understandably, than they were a couple of weeks ago. But if you look at that, there's still suggesting that oil prices are more likely to be back around the $75 mark in 3 months' time. There's a similar picture kind of seen in the futures market. So for what it's worth, notwithstanding the huge swings and volatility at the front end, it does still seem as if the scenario being baked in further down the line is that things will be back to some degree of normality. Now, prices higher than they were coming into this, that could be proved wrong, but I think that's an interesting facet of the market moves.
We've had this news of the big release from the IEA yesterday, so on Wednesday. It hasn't provided much relief to markets, as I say, with further disruption in the Strait of Hormuz. How much further intervention can we expect, and will it be enough to calm the market in terms of giving the supply that it needs?
Yes, well, I think in terms of the announcement itself, it wasn't a surprise. I mean, these oil reserves are a metaphorical rainy day fund to be drawn upon, and it's metaphorically raining right now. So it wasn't a surprise to see them use this. In terms of the scale of the drawdown, that's got a lot of attention. This is the biggest proposed drawdown of IEA oil reserves. It's on the face of it, more than twice the size of the drawdown and seen in the wake of the Russia-Ukraine war. But none of that's surprising. I think the key point looking forward is that 400 million barrels seems like a big number. And to put that into context, that's about 4 days of global supply. The key point is that the firepower is not unlimited. The IEA, we estimate they've probably got around about 1.5 billion barrels they could potentially draw upon. But crucially, when we compare that against some of the disruption and loss of oil output you could expect to see in a prolonged disruption and one in which energy infrastructure gets affected, I mean, that could dwarf the scale of the sort of reserve. So it really isn't a substitute for the opening of the strait. It's something that can offset some of the problem, but yeah, not all of it. The other factor as well, and I think kind of explains why it's not being seen as an absolute sort of answer to everyone's prayers, is that there is also constraints in the ability to get that oil to market. So at the minute, we're probably losing something in the region of 10 million barrels per day of supply. At best, when this supply from the drawdown of reserves comes through, it looks to be somewhere in the region of 3 million barrels per day. So a decent number is going to be trickling through. So it's not going to be a one-for-one help. The other thing I think a lot of people have kind of missed in the headlines is that for IEA's reserves, oil reserves, are obviously incredibly important, but China has been building up its reserves at a rapid pace in recent years. And for context, it holds stocks of oil, it seems, broadly comparable to the size of the IEA. So I think the key point, there's a lot of uncertainty as to whether China will draw down its own stocks. But I think the key point is that even if it stops adding to the stocks, this will offset some of the demand we've seen for oil in recent years. So put it into context, estimates out there suggest that stock building in China has added around about 1 to 1.5 million barrels per day to oil demand in recent years, about 1 to 1.5%. So yeah, that's one factor that can relieve some of the sort of demand pressure.
Jonas, I want to come back to what David was saying about there being some semblance of calm in some parts of the energy market, because that kind of reflects what's been happening in financial markets as well, doesn't it? I mean, you look at the headlines, you'd think the world was on fire. Yes, markets have sold off. Yes, it's risk off, but there doesn't seem to be outright panic. There does seem to be some rationale in trading around the duration of the fighting. Is that a fair take?
Yeah, I think that's right. I think they certainly felt a bit panicked at the start of this week, but things have stabilized to a degree over the past 2-3 days. I think it's a very difficult situation for financial markets to try to price, because there's just so much uncertainty around how the conflict is going to evolve. And as David was saying, the information that we're getting is very piecemeal and incomplete. And I think for financial market participants in particular, we're used to dealing with, what we consider rational actors or money-motivated actors, if you will. And obviously what is going on here is a different set of incentives, a different set of reaction functions that are not familiar and not well understood, and times seem to be changing as we go along. So it's a very difficult shock in that sense to deal with. And that's part of what we're getting, all this volatility and a lot of whipsawing up and down, is things seem to be improving and then they get worse and then they improve again. And I think there's two sort of key aspects that are shaping the market response to this conflict. The first one, and both of them are a bit different from what you would see in kind of a standard risk-off scenario, which we think of risk-off as being, typically it's about a negative growth shock. The economy weakens and then that leads to a risk-off sentiment. In this case, there's sort of two other aspects that are really dominating. And the first one is the terms of trade shock, obviously in favor of energy exporters, at least the ones outside of the Gulf that are not affected by the conflict. They get higher prices, and the flip side of that is it's a negative shock for energy importers. And that is shaping a lot of the relative performance that we're seeing, certainly in equity markets and then also in currency markets, where the US is holding up much better than major markets in Europe and Asia, which makes sense. The US is basically net neutral in terms of its energy imports and exports. It's a small exporter, but it's more isolated from the shock than the importers in Europe and Asia are. And then, of course, other energy exporters like Canada, Brazil, Australia these days, they're all on the holding up better side, and the importers are on the losing side. And the other key aspect, which is really difficult to deal with, is this is stagflationary shock. So not just weaker growth, but also higher inflation, which means that it's not just equity prices which are falling, bond yields are up, which is another way of saying bond prices are falling. Which means from an asset allocation perspective, portfolio management perspective, there's really nowhere to hide. Both bonds and equities are getting hit. And even worse, some of the standard alternatives, if you will, alternative safe havens like gold, that price of gold has basically trebled in the past 2.5 years. And so it's seen as pretty overvalued to the extent you can value gold at this time. So it's not really, I think there's a lot of skepticism that can keep going up, even in this kind of scenario. So it's a pretty tough environment overall, is how I would sum it off. It's not just the short-term volatility, it's the fact that there is there are no good places to hide, in the event that the situation continues to get worse.
And underlying it, as you say, this concern about exactly where the economic vulnerabilities lie in terms of whether you're a net buyer or a net seller of energy. That leads me on to really where we go from here. David, what to think when we're thinking about this conflict and the outlook?
Well, from an energy market perspective, I think the key framework that what we've adopted is there's two key uncertainties: how long the length of disruption to the flow of energy through the Strait of Hormuz persists, and increasingly the extent to which there is any lasting damage to energy facilities in the Gulf, which constrains the ability of the region to produce even after a ceasefire scenario. So that's the sort of framework we've adopted. There's all sorts of other assumptions you have to make, particularly around the extent to which energy produced in the region can bypass the strait. So obviously, there's been a lot of focus on the east-west pipeline in Saudi Arabia. That means they can, in theory, export quite a decent proportion of their exports out to the Red Sea. So all sorts of assumptions. But we've used this framework to construct three different scenarios. I think the most benign scenario is one in which you get around 2-week disruption to shipping through the Strait of Hormuz, and then it takes a while to come back. But in that sort of scenario, just to put some figures on it, we've estimated you'd probably lose about 1 to 1.5% of total global energy flows this year, so energy and gas. This is quite a substantial hit, and obviously will be all else equal consistent with higher prices. But actually, in this scenario, I think things we're assuming would be relatively back to normal in the second half of this year, and it wouldn't prevent prices from falling again over the second half of this year. The more extreme scenario, there is a middle scenario in which disruption lasts a bit longer, but you don't get any persistent damage. The most extreme scenario we've considered is a substantial closure of the Strait of Hormuz, and not only that, one in which you get persistent damage. Potentially, and most in the sort of headlines, if Iran's ability to export oil from its Kharg Island facility, through which about 90% of its exports leave, if you assume there's going to be persistent damage for that could easily stretch into years. We saw this during the Iran-Iraq war during the 1980s, that damage to this is not repairable in a very short time frame. In that sort of world, you could be staring down a barrel of around about 8% fall in global energy flows in 2026 overall. And in that scenario, disruption would likely continue into 2027 as well. So in that sort of world, that's when you're talking about oil potentially staying in triple figures for the rest of this year, potentially into 2027 too. That's how we're thinking about it.
Okay, so Neil, translate all of this into macro outcomes. David's there talking about a relatively benign scenario, relatively short conflict lasting a matter of weeks, and then prices coming back from roughly where they are now over the second quarter, over the remainder of this year. And then that more extreme scenario where we're looking at prices staying in these triple-digit levels for a while. We've got a lasting damage to energy production. Between those two poles, what does this mean in terms of the global macro outlook?
Well, at the risk of stating the obvious, the macro outcomes of both of those scenarios are rather different. If we have a severe but short-lived conflict, then I suspect the impact on both global GDP, inflation, central banks' monetary policy is going to be quite limited. It could be quite fleeting. In the relatively benign scenario, there's a pretty modest impact on global GDP. It's almost, you can't really see it in the forecast, frankly. Europe and Asia are hardest hit, but again, not much of a downgrade to forecast. And in the US, growth pretty much continues as it is. There's a bit of a hit in kind of March and April as there's a squeeze to real incomes in US households, but then that recovers over the course of Q2 and into Q3. Likewise, we get Eurozone inflation at 3%, but then falls back at the second half of the year. There's some volatility in US inflation, but it's short-lived. And central banks don't really respond. In contrast, if you get a much more prolonged conflict, then I think two things happen. One is, at the risk of stating the obvious, as I say, the macroeconomic consequences are much greater. So we end up in a situation where potentially you end up with a quarter, maybe even 2 of contraction in output in the Eurozone. You get a more substantial slowdown in growth in the US. You get a bit of a slowdown in growth in China too. You certainly end up in a situation where near-term rate cuts are off the table. But the longer this conflict goes on, the more central banks will be worried about inflation expectations becoming unanchored, and okay, the situation is different from 2022. We can get into that, but potentially you start to get rate hikes coming onto the agenda. And the second important reason why the duration of the conflict is so important is that the longer it goes on, I think the greater the scope for kind of what economists call non-linear effects. The longer this conflict goes on, the greater we reveal other choke points in the global economy beyond energy. We start to get, for example, problems in shipments of helium from a major producer is Qatar. That's used in semiconductor production. If that's disrupted and chip production is disrupted as a result, then that feeds through into broader consumer electronics, vehicles, et cetera, production. Maybe we get more disruption to fertilizer shipments, and that has an implication for food production and food inflation. So these effects become non-linear as the conflict persists and increase over time. So yeah, at face value, it looks quite simple. Short-lived conflict, relatively limited impact, longer conflict, more substantial impact. But within that, there's an awful lot of nuance. And as I say, these relationships become non-linear.
It does feel, I mean, you mentioned there 2022, Russia's invasion of Ukraine. Up until a few days ago, there had been comparisons looking at the current situation with what happened last year, the 12-day conflict between Israel and Iran. It feels like we're past that. You mentioned just then these derivatives from oil and gas and how they're being disrupted, as did David, talking about what's happening with jet fuel. There's obviously, as you say, there's fertilizer, there's chemicals, all sorts of things that are made from these core ingredients. How useful is 2022 in thinking of a model of how an energy shock can affect economies, but also how useful is 2020? How useful is COVID when we're thinking about disruptions to supply chains?
Yeah, so if we just start with 2022, I mean, at face value, actually, this has the potential to be much more significant. While Russian oil and gas pipelines were a critical energy artery, clearly for Europe, the Strait of Hormuz is a vital artery for global energy supplies, carries much more in terms of kind of global oil and gas flows than is the case with Russia to Europe. So it has the potential to be much more severe. However, that gets us back to the question of how prolonged is this conflict and how extensive is the disruption to energy supplies as a result. I think there's also some important differences in terms of the macro starting point and indeed the starting point for policy. So if you cast your mind back to 2022, what happened was that Russia's full-scale invasion of Ukraine, the energy price surge that followed that, set in train what was the most aggressive tightening of monetary policy that we had seen for 4 decades, and an almighty collapse in bond prices and a great kind of bloodbath in bond markets. Now, what were the conditions that led that to happen? Labour markets were extremely tight. There was still a large amount of fiscal support that was rolling off from the pandemic. So households' balance sheets were very strong. They were sitting on excess savings that helped to cushion the blow to real incomes from higher energy prices. Monetary policy was extremely loose. It started from a position of being extremely loose. Interest rates near zero, even negative. In some countries, real interest rates negative across the board. So central banks caught on the back foot. And because inflation expectations were quite elevated already elevated due to the pandemic, the effect of the pandemic, that meant that central banks were caught on the back foot and then had to scramble to get policy back to at least a neutral setting and perhaps even a more restrictive setting. Compare that with the situation today, and labour market conditions are on the whole looser. That's true in all economies, actually, to a greater or lesser extent, particularly in the UK and the US. Not quite so much in the Eurozone, but still looser than in 2022. Inflation expectations have drifted down. There's no longer the legacy of the fiscal support from the pandemic playing a role in cushioning this terms of trade shock. And of course, most importantly, monetary policy is at broadly neutral settings in most countries and may even be slightly restrictive in the case of the UK, possibly the US too. So the conclusion from all of that is that when we're thinking about monetary policy and how that feeds through into financial markets, we're in a very different position now than what was the case in 2022. Back then, central banks, as I say, caught on the back foot, had to scramble to tighten. Now, I think it's much more likely that they just stand pat. They've got policy at a neutral setting. They have a bit more time to wait and see how this conflict plays out, how it feeds through into second round effects on wages and prices, and then how they might have to respond.
David, let me come back to you because we spoke there in our relatively benign scenario about how prices would fall back. Prices were about $60 before this all kicked off. You've been talking to clients for the past 13 days, even longer, about the centrality of the Strait of Hormuz in this situation, the key role that it plays in delivering energy to the global economy. Let's imagine the fighting does stop tomorrow with the current Iranian regime in charge. The fact that this regime went and closed the Strait of Hormuz, when you say that prices fall back, would that still leave energy prices both elevated and volatile? How much will this question of security around the strait now weigh on prices?
Yes, I think it will be central. I think, yeah, as you say, if fighting stopped tomorrow, you'd get a relief in the energy markets in the sense to which that resulted in the flow of energy resuming through the straits. Just to be clear, that wouldn't be a complete and instant return to normality. The fact that production has been shut down in Gulf producers because of a lack of ability to get rid of that oil and because of storage facilities being filled up, it could lead to quite a sort of stop-start resumption of shipping through the strait. Also, the fact that you've got lots of ships out of position as well. So that would take a bit of a logjam, would take time to clear. But then, even after that, so those sort of traders kind of got their head around that. I think the key thing to consider would be the willingness and the ability of whatever regime is in place in Iran to continue to try to use the straits as a sort of weapon in constrained shipping through the straits. I think all too often in recent years, I think people have been guilty about talking about the closure of the strait as if it's a binary thing. I mean, it's incredibly binary now, but as we've seen in recent years, there's been a step up in sporadic attacks, sporadic seizures of ships. There's been numerous instances of like GPS jamming. So I think it's inaccurate to talk about the day after the end of this war, shipping going straight and back to normal through the Strait of Hormuz. As to what that means for energy markets, I think what we're kind of assuming, if in that sort of state of the world, that scenario, would be that prices would come down as a relief of flows of energy resuming, but we're assuming that you would get a sort of persistent risk premium baked into the price. So to put some numbers on that, the scenario we put out last week would be in a sort of benign scenario, shipping resumes over the next couple of weeks, you could get Brent crude prices back down to $65, $70 per barrel by the end of this year, which clearly is a lot lower than they are now. But to put that in perspective, that's higher than we would expect them to be in a no-conflict scenario. So in a no-conflict scenario, we were expecting the interplay of OPEC production and, soft conditions in the global oil market to be the dominant factor this year. I think that goes out the window. I think, the persistent risk premium associated with the sort of risks around shipping in the Strait of Hormuz to persist.
I want to come back to that because obviously there's implications there for how central bankers perceive some price pressures stemming from energy. But before I do, Jonas, given what David said, oil's just not going to snap back to where it was. Is that similar to what we'd expect in financial markets? Are we going to see some elevated perception of risk around what's happened over the past few weeks?
Yeah, I think that's right. I think we've already gone too far, such that it's going to be hard to put all of the toothpaste back in the tube, if you will. You guys were mentioning the 12-day war as an example, as a sort of one example of how this could play out. I think we're already past that, both in terms of the amount of shock that we've seen and also, I think this is day 13 or 14 now. So it's sort of too late for a full and rapid unwind. If we're in scenario one, I think that is where the market is putting most of the probability still. So it's the case that, I don't know, you can't put numbers on it if it's 70 or 80% or whatever, but there is some probability also being put on scenarios 2 and 3 and maybe even worst case outcomes. And that is where most of the sell-off is coming up from. So if it becomes clear that we're in something that looks like scenario 1, I think there will be a substantial relief rally, as an immediate reaction. But I don't think we get all of the way back to where we were at the end of February. There's several reasons for that. The most obvious one is what David was mentioning about, the persistent risk premium in energy markets. So that means the terms of trade shock that we were talking about earlier, that doesn't fully unwind. It goes back towards where we were at the end of February, but not all of the way there. I think in terms of the bond market, I think there probably is more potential for full or almost full unwind there, because I think in scenario one, what will have changed is the timing of some of the policy decisions from central banks, but not really the end point. I think that was the point that Neil was making. The end point doesn't really change. The timing changes. Bond market are forward looking. I think you're going to get most of the way back to where we were before the conflict, in that kind of scenario. I guess the other thing to bear in mind is that, this kind of shock, some things that we were seeing at the first couple of months of the year were looking a bit unsustainable anyway. And then you get the shock come along, completely unrelated really to those phenomenon, but it's going to be hard to get back to the dynamic that we had 2 weeks ago. I think a couple of obvious examples are probably the Korean equity market, which, it was up 50% in the first 2 months of the year. Pretty clear signs of a sort of classic bubble there. That might have been sort of knocked off its course permanently, or at least it won't come back in full force. I think another aspect is if you look at credit markets, both corporate credit and sovereign spreads were extremely tight going into the year, and in the first couple of months of the year, the tightest spreads that we've seen since 2007. So I think it might be hard to get all the way back to that kind of extreme optimism, especially when it comes to bonds that have a more direct link to the Middle East region and to energy, where, as David was saying, some risk premium is going to linger. And I guess the third and final point is, we've also had other news the past couple of weeks. It's the war has taken almost all of the headlines, but there's been bad news elsewhere too. In particular, the US payrolls report that we had at the end of last week. There was a big negative print there. So I think the labor market in the US doesn't look to be quite out of the woods. I think that's a negative for risk sentiment. We also have these ongoing rumblings around the sustainability of the AI boom, and tangentially related, but also the separate issue is the turmoil in private credit markets in the US, where again the news flow has been pretty negative. So I think that we're not going to go back to the kind of optimism that we saw at the start of the year just because the war goes away. That there'll be other things to worry about. The near-term outlook does certainly looks worse than what we had coming into the year. Now I think none of those things are kind of the end of the world necessarily. I think our baseline scenario is still a pretty optimistic one. So I think we can get back to a more positive risk sentiment. It's just going to take maybe more than just the end of the war, and it might take a matter of weeks or even months before we get back to where we were sort of mid-February time.
So regardless of what happens, regardless of the duration of the conflict, whichever way you want to look at it, this is going to be a turning point. Neil, with all that you said about what this means for central banks, Jonas just talking there about what we'd expect bond yields to do in the event of an end of conflict situation, I have to ask you, we've got Fed, Bank of England, ECB and Bank of Japan meetings in the coming week. As you're just saying, maybe a couple of weeks of fighting isn't enough to dramatically shift thinking at the committee or council level, but it is going to give central bankers pause, right?
It will certainly give them pause for thought. And I think what it does do is it removes the possibility of immediate rate cuts by central banks. Indeed, that's the price action we've been seeing in markets, these rate cuts, particularly for the Bank of England being priced out. I think that's broadly right. Now, if you're a central bank, there's nothing you can do to control the price of energy, the price of oil and gas, which is set in global markets. What you can control is the second round effects of any energy price surge, or you have greater influence over the second round effects of any surge in energy prices. And you can make sure that, or help to ensure that the inflation expectations remain well anchored. I think that's essentially where central banks are going to keep their focus over the coming weeks and months. That is to say, ensuring that the second round effects of this energy price surge are contained, ensuring that inflation expectations remain well anchored. In practice, what that means, I think, is that you leave policy broadly unchanged in the next month or so. You're in wait and see mode. If the conflict ends and energy prices drop back, then I suspect central banks will remain on their kind of preset course. That is to say, more rate cuts coming in the UK, more modest cuts in the US. The Bank of Japan, I think, will continue to hike. The RBA too in Australia, we're forecasting a hike this month too. If the conflict becomes more protracted, however, then those central banks where policy was either going to be unchanged or they may have entertained rate cuts, I think rate hikes then start to come onto the agenda, probably not very quickly, but they might start to come onto the radar as we move through Q2. If we get a further surge in energy prices that looks like it's persistent, that looks like it's unanchoring, causing inflation expectations to become unanchored and increase. Now, that's not on our baseline scenario at the moment, but that's the key danger to watch over the coming weeks and months.
That was Neil Shearing, David Oxley and Jonas Golterman on scenarios for energy supply, for energy prices, for global macro and markets, for central bank responses, all around this ongoing conflict in the Middle East. We've now got a suite of analysis which talks about the outcomes of these scenarios across commodities, financial markets, as well as individual countries. So looking now, I see for the UK, for example, scenario 1, our relatively benign scenario, that entertains the idea that bank rate could still fall to 3%. But that more extreme third scenario sees the Bank of England raising rates, maybe to 4.5%. It's times like this when it makes sense to use scenarios as a framework for thinking through macro and market implications. That's why our scenarios, I think, are getting so much attention. Martin Wolf wrote about them in the Financial Times on Wednesday. The Wall Street Journal has covered them, Reuters too. So if you've read the coverage, you're not a client, and you want access to our scenarios, to all of our analysis on this conflict, plus daily online briefings and much more, then do get in touch and we can set up trial access pronto. Write to us at podcast@capitaleconomics.com today to start exploring our scenarios. But that's it for now. We are continuing to monitor how this conflict is evolving and what it means for global macro and markets. We'll be back soon with another show to talk through how economies and markets are reacting. Until next time, goodbye.